All right. How's it going, everyone? I hope you guys are having an amazing night so far. So today for lesson 2 of Motivated Trading Company live lessons, we will be doing an introduction to options and all of everything you need to know about options trading. So right off the bat, what is an option contract? An option contract is the right to buy a call or sell a put. Or wait, let me restart here. I'm trying to admit people do too many things at once. What is an option contract? So an option contract is the right to buy or sell 100 shares of a given security, which could be a stock, an ETF, an index, any sort of tradable token per se, at a certain strike price by a given expiration date. So it's very common that you'll see option contracts expiring on Fridays, which is why we typically just have these weekly expiration contracts. You'll also experience monthlies, quarterlies, and various expiration dates for contracts. And the key emphasis I want to put is on the right to buy or sell a contract. So this is a tangible item that is allowing you to essentially lock in the price on a trade. So this price of the trade will continue to fluctuate, meaning if you were to buy this tangible contract at $10 and you want to sell it at 15, you can sell that. You're selling the rights to whether it be to buy or to sell. You're selling that away to the next person and you're taking the profit, or in some cases, the loss that comes associated with that. Now, you can hold these contracts until expiration and execute them, or exercise, as we say, which basically is buying the 100 shares or selling the 100 shares. But for most options traders, you're not really doing that. So as an example, if you were to see an Apple 128-2022 160 call, what you have is the right to buy 100 shares of Apple stock at $160 per share on January 28th. Now let's say you were to buy a Facebook put for the same expiration at $300. You have the right to sell 100 shares of Facebook at $300 on January 28th. So I'm going to move on to our next slide where I'm going to give you guys an analogy. So let's say you have a coupon for a PS5, and let's say the PS5 is worth $500 at Walmart or Best Buy or wherever you bought it from. And this coupon is going to allow you to buy it for $100, right? So the coupon is very valuable. You're buying this PS5 that's worth $500 for 100. You're saving $400 essentially. Now, let's say you were to buy a call option for the year 2023 on a brand new stock. And in 2023, that stock becomes $10,000 a share. And you bought this contract for a $50 strike price, for example. So as a result, you're buying 100 shares of this company at $50, but this company is currently worth $10,000 per share. So you guys can see where this value behind like the option is coming from. Now, let's say you have a coupon to buy a PS5 today for $1,000. Now, hypothetically, you can go into Best Buy, buy it for $500. You'd be paying $500 more. There's no value there. No one wants to pay more for something that they can buy for $500. That's what we call an out the money contract. I'll get to that later on in a few more slides, but just on that same note. So let's say Sony announces that PS5 production is going to drop. PS5s are now worth $2,000 per PS5, and you have this $1,000 coupon to buy it for $1,000. Now this contract that was originally worthless because you'd be paying more for the product than what it's worth. Now you're paying less for that same product, even though it's priced at $2,000. So as I mentioned before, the strike price. So this is basically where you're buying or selling these 100 shares at. So if you look over here on my screen, you can see that the share price of these SPY contracts is at $433. Now, if you were to buy 100 shares at $434, you'd be paying 3.95, which for those who already know how options work, it's 100 shares per contract. Wow, there's so many people joining this waiting room. Okay. But yeah, so like you see how like right here, it says 3.95 on the contract. That's because the current share price of SPY is $433 per share, meaning if you were to have a coupon, quote unquote, to buy SPY for $434 per share, you'd be paying less money because, as we said earlier, like that is less valuable to the person possessing it. Oh my gosh, this will never stop. Now, let's say you were to look at this 430 call. If you were to buy 100 shares of SPY at $430, you're saving $3 per share. As a result, you're paying significantly more for that contract, which in this case would be $600 versus $395 for the 434. So that's just a rough way of understanding of how strike prices work. Meaning if a stock is worth $10 and you want to buy a $15 call, that'll be cheaper than buying a $5 call, because at the end of the day, someone can just go on the market, buy 10 shares of it for $10, or they can buy your call, exercise it, they'd be paying $5 more. So we call that option moneyness, which is basically whether or not an option is in the money or out of the money. And I'm going to pull up a brokerage so that way you guys can see this directly on like a blockchain or on an option chain. And yeah. Wow. So many people. So the next thing we're going to tackle is the option Greeks. So there are 5 Greek values for option contracts. You have delta, you have theta, you have gamma, you have vega, and you have rho. The 2 most important ones that you want to pay the most attention to will certainly be delta and theta. So what delta is delta is the amount your contract will change in value per dollar move in the stock price. So like, let's say a contract has a delta of 0.50, and then that stock price goes up $1. So now your contract is going to go up 0.50 per the 100 shares. So 100 times 0.50, $50. Your contract is just increased in value by $50. Now theta is the time decay. So if you guys recall earlier, we said that these options, I'm going to pull up the screen again, just so you guys can remember, these options are always by a given expiration date, right? So let's say you have, like in our PS5 analogy, let's say you have to buy this PS5 at $1,000 on Friday tomorrow. If your theta value is very high, it means that your contract is out of the money and it's going to lose value very fast. I'm on the wrong slide. It is going to lose value very fast. So this is what we reference as time decay, meaning as you get closer to the day of expiration for a contract, if you are out of the money, then your contract will continue to lose more and more value until 4 p.m. on that given expiration date. Go ahead and mute. Yeah, if you guys keep all of your mics muted, please. So that's the theta. Next, we have gamma. So gamma is where things get a little bit more advanced. So what gamma is measuring like the amount of change that you will see in the delta value. So like, let's say you have stock A at $10, and then you have this $15 call on stock A. So let's say stock A jumps to $20. Your $15 call is now in the money. So your delta is going to continue to go up as it becomes more in the money. In other words, if you have a call option, as long as the share price is higher than your call strike, your delta will continue to go up more and more and more. Now, how much it will go up is relative to the gamma. Next, we have vega. Vega is a little bit more on like the negligible side of things. You don't necessarily need to like watch this, especially if you're doing short option positions. It's definitely helpful on very volatile days, like as we've seen this week, but it's not something you necessarily need to instill in your trading, but it represents the option sensitivity to volatility. So what that basically means is, how's your option going to react to like a choppy index or something of that sort? And then you have rho, which is the option sensitivity to interest. That one as well, fairly negligible. So at the end of the day, these are the 3 right here that you want to focus on: delta, theta, and gamma. These 2, they're important. They serve their benefits, but for most traders, like, we're more focused on these 3. So now we have some examples. So whenever you're looking at delta, you're going to see this very, very small number. It'll be like 0.22345 or whatever it may be. We're always looking for delta to be between 0.20 and 0.50. Now, when you're looking on a blockchain, it's very likely you'll see contracts that have a delta greater than 0.50. The reason it doesn't matter to have a delta that high is because those are typically going to be in the money contracts. And for most traders, you're buying at the money, like the same strike of like where the stock price is at, or if you're buying slightly out the money, because it gets cheaper the further out the money you are, which will all make sense once we pull up the option chain. So always look for that 0.20 to 0.50 range. And I personally prefer 0.30 as my sweet spot for picking the contract. Because if I can go into a position and buy, let's say, 1 contract for $500, or I could buy 3 contracts for $150 each, but those 3 contracts are still just as strong as that one singular $500 contract, I will always take the 3. But there's a limit to where you want to get to that, which will also make more sense once we get to the option chain. And then some special circumstances. So if you have a smaller portfolio, it will be difficult to find deltas in this range. For example, if you're trading on a $200 account and you're trying to trade SPY contracts or Apple contracts or whatnot, it's very likely you'll be finding like Need to admit someone. You'll be finding like a delta that's on the lower end. In that circumstance, you have no choice but to, just take this quote unquote worst contract. But as your portfolio continues to build and build and build, you can continue to buy safer and stronger contracts. The next thing would be like a high conviction trade. Like if you have insider information, or you have like, the strongest support of any support known to man beneath your stock, buying a contract that does have a lower delta will be okay in that scenario. Lotto positions. When we were seeing like the whole GameStop and AMC, I think this is a prime example of this. When GameStop was tearing, you could have bought like a $20 out the money, like $200 call on GameStop. GameStop squeezed all the way to 450. That $200 contract or $20 contract you just bought has now jumped to like $10,000, $15,000 in value, whatever it may have been at that time. So that's another place where you can, somewhat neglect the delta. And really, lotto play, squeeze play, kind of same thing. With those two, you do have deltas that you can play around with a little bit. Now, we have this delta to theta ratio. So what that basically means is that you want the positive change in your contract value to exceed the time decay of it. So in other words, you want the amount of growth your contract will achieve to be more numerically than the amount of loss it will take due to time. So in order to do this, it's like a very, very easy calculation. Let's say you just see a stock that has a delta of 0.30 and has a theta of minus 0.15, 0.30 divided by 0.5, 2-to-1 delta to theta ratio. That's perfect. Anything over 1, which in other words, just make sure your delta is always higher than theta. If your delta is not higher than theta, 9 times out of 10, you should not be buying that contract. Now, here's an example with like contracts that you can view right now. So if you were to buy an AMD March 11th, 2022 call for $105 strike, AMD is currently priced at $102.60. As you can see, this delta value is very high, even though it's out the money. Even though AMD is only worth 102 right now, so like back to our PS5 analogy, if you were to exercise this contract, right, assuming AMD wasn't to change, you'd be paying, what is that, $2.40 more per share. The reason this delta is so high is because the expiration is so far. Whenever you're trading a contract like that's further out, you're going to have higher deltas. And more importantly, you're going to have very low thetas. If you look at an AMD contract for today, such as this one, your theta is going to lose $1 per share in value because it expires tomorrow, even though your delta is still relatively high at 0.65. So this contract, for example, is a contract that many traders will take. Now, even though the delta to theta ratio is not in your favor here, this is like a very rare, very rare example of when you'll be in a position like this just because of recent market conditions. That's why like the delta is set up this way, but it's a good example nonetheless, because as you can see, this is still a very high delta. This is a 0.65 delta. Earlier, we mentioned we're looking for this 0.20 to 0.5 range. So we're above that. So it's a contract you can still take, but this just goes to show how you're almost buying the same strike price, but one of them is weeks out. And just look at the difference between the theta values here. Like this is a 10% of the theta. Like this contract will have 10% of the time decay that this one will experience. Then on to our next slide, we're going to go into gamma values. So a good analogy for understanding this would be that delta would be how fast you're going in a car, and then gamma would be the acceleration of said car. So delta is the change in price per $1, the change in the price of the option per $1 change in the stock price, whereas gamma is the change in delta per that same dollar change in share price. So if you have a high gamma, there's going to be a higher change in delta, meaning that there's a higher possibility that your delta value will fluctuate. If you have a low gamma, it's more set in stone that your delta value is going to remain the same. So where this can come beneficial is that if you have an out the money gamma, or this is where it's harmful. If you have an out the money gamma that's very low, like let's say you were to take a AMD 200 call, for example, the gamma will be very low. Your delta is not going to rise. So even if AMD goes up $20 from here, but you're still $80 out the money, your contract will not be in profit. Now, if you were to have an in the money gamma, so let's say we were to say like, if you had an Apple $50 call, even though Apple's trading at $160 a share right now, Apple could fall $20, your delta is going to be unchanged just because of how low your gamma is. So here are some examples on the left. So if you look at this AMD 128, 150 call, sad reality of getting your contracts at 0.10. Yeah, if you, for a lot of us who have seen it, like if you hold a contract that's out the money until like day of expiration on a Friday, it'll literally expire worthless. Like it'll expire for $1. It can be $1,000 contract when you bought it, $10,000 contract. If it's out the money on the day of expiration at 4 p.m., it has no value. All falling back to that PS5 analogy. At the end of the day, if I can go buy a PS5 at Best Buy for $500, there's no reason I should buy it for $2,000. Same thing with a contract. If you have an Apple call for $300 that expires tomorrow, no one's going to want that. No one's going to pay $300 a share for Apple if they can just go onto their Robinhood or Webull or whatever brokerage they're using and market order buy the shares for 160. So that's when you see like a contract become worthless. Right over here, we have this 80 call, for example. This is an in the money contract. As you can see, the delta's strong, the gamma's relatively higher or significantly higher than both of these contracts right over here. And you can see that like this contract can very likely change. Wait, this is a typo. This isn't even supposed to say 80 call. This is supposed to say 120 call. Because this was supposed to be an at the money strike. I apologize for that, everyone. This is supposed to say 120 call. But as you can see, the gamma is much higher. Now, why is the gamma higher? Because if AMD pushes higher, the delta will increase significantly. If AMD pushes lower, then the delta will essentially crater in this scenario because it's on the day of expiration. So when you're looking for a long-term contract, like let's say you wanted to play Apple calls 2 years from now, right? You want a contract that has a high delta, and then you want a contract that has a low gamma, because what that means is that your contract is going to retain its high delta and retain its low gamma. So then finally, I want to get into risk management. And then after this, I'm going to pull up an option chain so we can look at these in like real world examples. And then we're also going to cover like how to pick a strike price depending on where you're trading relative to like support or relative to a support or resistance level. So with position leverage, no matter what the scenario may be, never enter more than 20% of your portfolio into a singular trade, especially with option contracts. Because as many of us have seen, you can lose your money in options very, very fast, very fast. So if you're going into trades where you're leveraging 20, 30, 40%, and it goes in your direction, that's amazing. You know, your portfolio is going to look beautiful, but God forbid it doesn't. That's not a scenario you want to find yourself in. Ideally for like option contracts that are expiring in the same week. So let's say it's next Monday and you were to play a contract that expires next Friday. You know, you want to keep that somewhere between 10 and 15% of your portfolio. Don't over leverage into it, just because, as we saw earlier, the theta values on these contracts when you get closer to expiration are through the roof. So for share portfolios of high value stock, this is like an exception, you know, like if you were to build a portfolio that's 30% Apple stock, that's okay, simply because it's Apple. It's one of those companies that, you know, so we call our blue chip stock, like a company that will consistently show strength even in weak market conditions. So companies like Apple, Tesla, Facebook, Microsoft, if those are exceeding your risk management here, it's an exception just because it is shares. But in those scenarios, throw it in a Roth IRA, forget you even have it, look back at it in 20 years, and you'll be much happier. Second thing I want to get into is scaling in and out. So let's say you see a position that you find appealing or a contract you want to enter. When you enter this contract, don't buy all 5, or if you were to buy 10 contracts, don't buy all 10 at the same instant. You know, you can buy 1, 2, 3, 4 contracts. And then when you get more confirmation or any sort of directional confirmation, you can continue to scale more in. And it works in the other direction as well. Let's say you have 10 contracts of a stock and you think it's going to dip a little bit, but you don't want to exit out of the position. You can close 7 of your contracts, hold 3. Then when you get more conversion, when you get more confirmation that it's going to reverse to the upside, you can re-enter those 7. Trim and take profit. So what trimming is, I know we get this question in Discord all the time. So what trimming is basically, let's say I have 10 contracts and these contracts are all up 50%. I'll sell 5 of them. So I've secured 50% profit on 5 of my contracts. I'm holding 5 more. Let's say we hit 70%, I can sell 3 more. Now I'm holding 2 more contracts, just, you know, inching that stop loss value higher. And then you're just securing gains as you go. So that way you don't have as much risk on the table. And now we are going to transition to, get out of this. Now we're going to transition to Robinhood, just so I can show you guys how to, it's funny. So now we're on Robinhood and we're looking at an actual option chain. So like, let's say we were to click on this 432 call. Right over here, you can see your delta value, 0.48. This is something we can work with. You look at your theta. Your theta sitting right here is at negative 0.69. So what this means is that for every dollar out the money on the day of expiration, so this being a $432 strike on a $433 on a $433 stock. Let me take a breather. You have a 432 call strike on a $433 stock. So this is an in the money stock or in the money contract. As a result, I just lost my train of thought. Okay, let me restart here. You have a $432 call option on a $433 stock. This is an in the money contract, right? So we have this very high delta. Now, the reason this theta is so significant is because this contract expires tomorrow. This is one of those exceptions I was trying to make earlier, is like on the day of expiration, you can still trade this contract just because it's in the money. It's already, you already have your high delta. If you already secured that 0.2 to 0.5 range, even though the theta is greater than the delta in this scenario, just because of SPY contracts expiring on Monday, Wednesday, Friday, you're just going to see that on certain scenarios, you will experience that. Now, like, let's say you were to look at a 445 call. This is the type of contract you want to avoid. Now, the reason I say that is because you have a very, very low delta. Remember, we want that 0.20 to 0.50 range. So we have this 0.12 delta right here. When you're looking at this and you have this theta, your theta is 3 times greater than your delta. You're looking at the theta down here. Theta is only 0.7 over 0.5. I don't know, 25%, 20% greater. So this is a manageable ratio in which delta is not greater than theta that you can still continue to trade. But when you're looking at this contract right here, your theta is 3 times the value of this delta. You want to avoid this contract. This is not something you want to trade. Now we can pull up any other ticker. We can go into Apple, for example. If we were to look at Apple options. So I over here went to August 19th. So I want to show you guys how this works with long-term contracts. So when you're trading a long-term contract, you're still going to attain these high delta values, but you're going to experience very, very low thetas, like almost negligible thetas. Now, keep in mind, this is also a $1,000 contract, so it's going to come with better Greeks. But in this scenario, this just goes to show like we have low theta, we have low gamma. So what this means is that in terms of time, we don't have to worry about time decay. In terms of our long-term delta, we don't have to worry about losing delta value as a result of the gamma. This is the type of contract you want to take. Now we're going to jump into a chart. I'm going to open a new chart layout just so I can show you guys how I would pick a contract if I was trading. So we'll go on to a 5-minute chart, looking at S&P index SPY right here. Let's say I was to do, assess that right there, assess that right there. We can also do, let's say we get this resistance right here. And what else do we want to play around with? Okay, so like let's take all of these levels that I've just marked on this chart. So let's see, maybe I can find a better example from this one. This will be a better example. I like this better. Let's go right here. All right. So let's say we're trading the S&P index, we're trading SPY in this scenario, and we marked our pre-market high right here. You can see that it faked out this pre-market high. It couldn't stay above this resistance. So this is the important level we're looking for, 441.25. So if I was to approach this contract on the upside, referencing that we have this pre-market support here as well, SPY opens, bounces off pre-market low, we get this bounce. So right now we're trading at 438. So hypothetically, you could go ahead and buy a 439 call right here, or you could go buy a 438 call. You could buy a 437 call. You could buy any call you want. Now, the best way to do this would be that we're looking for this to reach this 441 resistance right over here. So when I'm looking at this, my first go-to would be like, if I'm looking at a 441 resistance, I want to buy a contract that is out the money, that will become in the money as this person as well. So what we're looking for here is that we want to take this out the money contract that'll become in the money. So if you're trading you're bouncing off this $438 support, you would be looking at a call between 441 and 444, simply because as a contract becomes closer in the money, it gains value, it gains greater delta, it reduces its theta. So if I was to pick this, I wouldn't sit here and pick a 460 call. You know, you want to pick a contract that can still become in the money based off of the move you are trading for. So we do this all the time with SPY. We do this all the time. You're buying a contract a few dollars out the money. You're paying a very low premium, anywhere between, sometimes you can pay a premium as low as $40 for a contract that's only $5 out the money. This week is a bad example of that just because of all the red we've seen recently. So we're experiencing like abnormally high delta values and abnormally high premiums on all of our contracts. But in normal trading weeks, if you were to buy at this level right here, if you were to buy a 441 call or a 442 call, that contract is going to be no more than $100 to $150. In this scenario, you could buy a 438 call. It would probably be closer to $300 per contract. There's no reason to do that. You know, we're here, we're trading for the premium, we're trading for the growth in the contract. So what we want is we want this out the money contract that is going to become in the money. So if I was in this scenario, I would buy a 441 or a 442 call simply because we are looking for a break of the 441 resistance. How are leaps impacted by the current market dynamic? So with the current market dynamic, I would definitely advise you to stay away from leap plays in the near future, just in case we do go lower. But at the end of the day, like the market is very forward looking. I do believe that inflation is, a lot of the inflation issues we're seeing right now are some short-term fear. But in terms of leap plays, I think there are a lot of value stock that you can find leap plays on, like such as AMD. I think AMD is a great one. AMD was trading at $160 a share a few weeks ago, or a few months ago. Right now it's trading at $100 a share. Trying to think of some other leap plays you can look at. I think airline leaps are amazing. We saw airlines crash when the COVID pandemic started, and now we will slowly start to see them build back up as we start to see more quarter four earnings. I'm stuttering right here. We will start to see them recover as more quarter four earnings come out for these airline companies. But in terms of leap plays, I would definitely advise you to wait on that a little bit. Give it a few more weeks, just let the market shake its bones out, and then we can go from there. And yeah, will AAL recover? I feel very, very good about our AAL 617 calls. Like, it's definitely one of my favorite positions in my portfolio at the moment, just because American Airlines specifically has one of the youngest fleets out of all airline companies. So a good way of gauging like airline companies is that with all of these airlines, they have these aircrafts, right? So if you have an airline that, for example, that has planes that were built 20 years ago, that's an airline that you want to be concerned with, because they're going to experience negative cash flow in the future, just because they're going to have to spend money on repairing these airplanes, buying more, and anything associated with that. So the reason I like AAL so much is because they have the youngest airline fleets of all of their competitors. I think it was at like roughly eight years per aircraft, whereas you have some companies like Southwest Airlines, you know, their average age per plane is 15, 16 years old. One of the airlines reported profits for the first time in 2 years. Yes, sir. Exactly. So I think we'll see a lot of good with airlines, especially now that we're seeing a lot of countries transition from COVID being a pandemic to just being like something they're going to deal with. But yeah, so to continue this example, let's say we were to go onto a higher time frame on a SPY chart right here of how to pick contracts. Get this going. Get all these charts out here. So if, let's say we were to play like an option swing on, well, SPY's about it. What indicators do I use? I can get into indicators in a little bit. I just want to explain more about like how people should pick their contracts, and then we can tackle into indicators. So let's say we're looking at this AMD chart right now. If you were to pick an AMD option for next week, we can see that AMD has been trading in a massive downtrend, starts to curl up around the lower 100s. I know this specifically just because I remember playing the 100 break from AMD a while ago. The $100 level is a major support on AMD. So this would be a good time to enter into some sort of like 2-3 month call on AMD. If you were to buy a 2 or 3 month call on AMD in this scenario, the last thing you want to do is sit down and buy a $160 call for 2 weeks out from now. So what you want to do is you want to find a nearby resistance on this chart that you think AMD can break. And then from there, you want to base your strike price that you choose your contract off of from that. So let's say we were to break this rough double top right here. Not really a double top just because it wicked right above, but let's say we were to play this right here. If I wanted to buy a $115 call on AMD, it would be an out the money call. But if I was to project this for, let's say, a March expiration of a $115 call, that would be a safe contract to buy because you're buying an out the money contract that has a nearby resistance that it can later become in the money off of. Now, if we were in this scenario, you wouldn't buy a $130 call or $140 call just because of like the delta and theta explanations we had earlier. And then I do want to go back into like a short time frame for this same exact example. So if we're looking at this AMD chart right here, we could take this pre-market low break right here. As AMD approaches this pre-market low, you might be wondering, what strike put do I buy? In this scenario, you don't want to buy a $90 put. You want to buy something that you can tangibly like expect growth out of. So I don't even know what that sentence was. So with this AMD contract, if you were to sit here and pick a put to buy in this scenario as it breaks this support, you would want to make sure that you're not going too far out the money on the put side of things either. So you don't want to sit here and buy, like, for example, if you see AMD is about to break the $106 or 106 support level, you don't want to go and buy a $95 or $90 put on AMD too far out the money, especially if we're expiring tomorrow. You want to get somewhere between that 106 and 101, 102 range. If we go back to Robinhood, we can take a look at those options for AMD for tomorrow expiration. Why is this expiring in February? It's not even showing me the ones for tomorrow. All right, February 4th will work. So if we were to look at these AMD puts, buy put, you can go in here and you can essentially buy any of these various puts. If you were to go and buy something such as like a, let's say, $80 put on AMD, you're gonna experience a delta. That's the reason this is negative, is because it's a put. So it's gonna gain value as AMD goes down. So it just flips. So don't ignore the negative when you're looking at put Greeks. Just focus on the value of the actual delta itself. So in this scenario, you see theta that is double delta. This is not a put contract you want to buy. You want to go closer in the money. You want to make sure that, or closer at the money. You want to get something in the range of, like, just because of how inflated these contracts are from the recent dumps. Let's say we were to say a $95 put. This would be a much better contract to buy. Delta and theta slightly below that. We want delta to be greater than theta, but this is slightly below, close enough to where this would be a good contract to buy relative to this one that we mentioned earlier, where you're getting a delta that even if AMD was to fall $5 overnight, you would just lose all the value of the contract, you know? So this is how I would advise you guys to pick your contracts. Is if you see another level, AMD is bad because it's on a falling knife. But if we were to play like the upside on AMD, if you see a resistance, such as like if you were to play the break of this white line right here, this is at 116, you know, if you were to enter this at any point in the day, you want to make sure that you're not buying a contract that'll remain out the money when you're getting your move. You especially want to focus on making sure that when your specific move in the play comes, that your contract is going to go from out of the money to in the money. They also have the lowest exposure to Boeing. What indicators you use, please? So does that make sense? Is like, I feel like I'm all over the place right now, but does that make sense as to what I'm getting at with how you're supposed to pick these strike prices, about how to make sure you're not going too far out the money and make sure that you're buying contracts that can become in the money and become valuable through our PS5 explanation earlier? If so, just send me a message in the chat just to know. Otherwise, I can re-explain it in a different way. Makes sense? Perfect. 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 Do we have any questions so far? Does anyone have any specific questions they want to ask? I know someone wants to learn about indicators. We can get into that after this. Yeah, so if you have a smaller portfolio, certainly. So like there are tons of stocks. Y'all fall too back. Yeah. So there are tons of stocks that you can trade that are much cheaper. Like, for example, if you're to trade a QS contract, you know, QS is a $15 stock. If you have a smaller portfolio, if you're trading a $1,000 stock, the contract premiums are going to reflect the $1,000 value of that stock. Whereas if you're trading a $14 stock, the option premiums are going to reflect that as well. So with the exception of SPY and QQQ contracts, which is the S&P index and the NASDAQ index, All these contracts are going to be relative to like for example, if you were to look up a Tesla contract, they're going to be hundreds and thousands of dollars. You know, if you were to look up a QS contract, when we look at the options right here, you'll see that they are much, much cheaper. Like for example, a $14 QS call is only 107. If I open no memes, I don't use this account. AMD. If I was to open like an Apple call, we can go find like Apple's at 167. If we look at Apple options, buy a call, you can see right here that a 165 call on Apple is $262. You look at QS, a $14 call on QS is only $100. So just play a cheaper ticker. If you have a smaller account, simply put, just play a cheaper ticker. You know, they're going to make similar moves. They're going to follow the S&P closely. A lot of them will. You know, QS, maybe not the best example, but you can do AAL. Let me put this side by side with SPY. You know, at the end of the day, it's still going to follow the index fairly close. Very, very similar charts. Make sure these are on the same time frame. Yeah, same way SPY opened up hot, rose up, rejection. SPY experienced a greater bounce than AL didn't reflect this bounce as well. Same sell-off that SPY had right here. Same consolidation into the end of the day. Same recovery into after hours. So if you wanted to trade like a cheap, if you have a smaller account, like I'd say less than like $250, $300, you know, with an account of that size, definitely just play like cheaper stocks. There's like QS is a good one. AAL is a good one. We have tons of like EV stock that, you know, NEO, $21. I think Rivian, Rivian's a little bit more pricey, but even Rivian, a $50 stock, like the options on here won't be that expensive. Like right here. Oh, actually, I guess Rivian calls are very expensive. That's surprising. I did not expect to see that. But yeah, just trade a cheaper stock if you're on a smaller portfolio. Okay, we was playing SPY puts 4.51. Can you explain that? Yeah. So on here, I'm gonna have to look for it on my phone just because Robinhood's not gonna show me it because this account doesn't have any like balance in it, so I can't trade same day expiration contracts on this account. But I'll check on my own portfolio. We trade SPY contracts. So we're on SPY. We're looking at the 434 call. Right. So today we traded a cheaper SPY contract just because with SPY being an index, it expires Monday, Wednesday, Friday. So there are significantly more contracts, meaning that when we get closer to expiration, that theta is going to hit them hard. That's why we're able to trade like a $50 SPY contract 2 days before it expires. How do I know when to exit the contract or when to stay more for profit? So you want to exit a contract as whenever you're trading, you always want to make sure you're following the S&P index. Like for example, if you see the S&P start to show weakness here, it forms this top right here, right? So as soon as you see the S&P form this top and you see that it's starting to struggle to get above this level right here, you'll see the same thing on like, let's say AL, just because we were looking at it earlier. This is right when the S&P started to reverse. You see the same reversal on American Airlines right here. This reversal right here is the same thing as this. Because remember, these indexes are made up of all of like the top stocks in the stock market. So they reflect the general direction that the stock market will follow. So the easiest way to know when to get out of a position is that you should just follow the index. If the index reverses and you're in a call, cut the call. Unless it's like just one of those plays that's, you know, trading without regard to the S&P or without regard to the NASDAQ. That's a very easy way. Another way is use pre-market levels. So pre-market levels are very, very beneficial, like especially whether it's on an index, whether it's on an underlying stock. Use the same delta theta rule. Okay, you said do you use the same delta / theta rule on SPY and QQQ? With SPY and QQQ, it's a little bit more negligible just because, like, as I said earlier, you have Monday, Wednesday, Friday expiration. So the thetas are just like significantly higher on them. And for how fast the S&P changes in value, like, you know, we had singular candles today, like this is a 432 open to a 433 close. Like that's a dollar candle. You know, this one candle alone was probably like a 5 to 10% move, you know? So with S&P contracts, it's a little bit easier to, you know, avoid have a greater delta than theta ratio. But if you can set it up to where you will have them at least close to each other, or ideally have delta greater than theta, it's the best way to do it. Also with S&P positions, do not go heavy. I see it all the time that people will go very, very deep into SPY and QQQ positions. Unless it's very high conviction, there's just no reason to go heavy, simply because like you could have played calls up right here. You could have played puts down. You played calls again. You could have played puts down. You could have played calls again, puts down. Like that's what we were doing all day today, was that we played calls in the morning, then we played puts down, and then people caught calls again, and we played puts down. So you can just keep doing that all day long, you know? But yeah, so how do I know when to exit contract? A support, a resistance, and the index. Like those three are really all you got to do. When it comes to profit, you know, you can also take the approach that it's like, I got my 20%, let me just get out. I do that all the time, especially like this whole week has been very, very choppy. Like look at the SPY 30-minute chart. It literally looks like a barcode. Let me go to the 1 hour. You can see right here that this entire week was just like some up, down shit like the whole time. Like it was just a very, very choppy week. Like this was not the week to be back holding positions. You should literally just like take your profit, get out. So like for example, you can take, this is really what we were doing, just on a larger, like an easier way to read it, was like same concept as we saw on SPY today with this 3-minute chart. Same way I said earlier that, you know, we take calls up, take puts down, could have done the same thing. Take puts down, take calls up, take puts down, take calls up, take puts down, and so forth. There was another question I wanted to tackle. You can have a stock track. How do you know when to exit the contract? Oh yeah, the pre-market levels, I live by these. I literally live by these. Like I think this is the best way to know like your entry and exit for a contract. So if you pull up like a 3-minute chart, you just mark all these pre-market levels. You guys are probably sick of me for bringing this up just because I mention this every single day. Like check your pre-market low, check your pre-market low. Which you could probably even take this after hours level. Oh yeah, definitely. Just because it showed respect to it right here. You know, these are all trade positions. Like you could have seen this wick, see that it didn't close below, take calls up. You notice that it starts to reject here. It's similar to our resistance that we identified up here. You identify this bearish hammer, this candle right here. I don't know if you guys, for those who aren't familiar, this is called a bearish hammer. Whenever you see a low wick, but the candle closes high, it indicates a reversal, like it's just a price action candle. So if you see this, that's a sign to get out of your calls. You know, you see it break, let's say you're in calls here and you got stuck on this downtrend and you see it broke this pre-market high resistance, because keep in mind it's a support in this scenario. That's when you would cut your call. You don't want to back hold your call down. So really just like take note of all the important price levels, which we drop in main chat like every single day, nonstop. You will constantly see like easy price levels to trade. You can play breaks like right here. If you were trying to trade the reversal up and you recognize that it didn't get above this resistance right here, you're just going to ride puts down. You break this level, hold your puts, rejects again. You could have taken another put. Like that's a $1 candle right there again. So in terms of how to know when to cut your calls, like support, resistance, pre-market levels, and the index. Never trade against the index. Never. Do I book one-on-one trading sessions? Yeah, shoot me a DM on Discord and we can definitely chat it over for sure. There are a lot of you guys, so definitely bear with me in terms of scheduling, but I have no issue with doing one-on-one trading sessions. Do you believe industry knowledge is helpful in options trading? I've traded options on underlying stocks such as AMD and Intel based on my knowledge of the semiconductor industry. I wonder if this is a practice you recommend. So I would value industry knowledge under like a more fundamental approach to trading. In terms of trading options with it, it's very tricky because keep in mind AMD and Intel's day-to-day price change isn't reflective of like the semiconductor industry. Their day-to-day price change is reflective of the overall market, the overall market performance. So you could take let's say yesterday during Federal Chair Powell's meeting. Let me pull this up on the SPY chart. Nothing would have stopped any stock from falling with SPY like this. No matter what their industry is doing, nothing would stop that. Like options is certainly a very, very technical game. Like if you're going to use industry knowledge, use that for your shares, use that for your Roth IRA. But if you're trading options, like just keep in touch with market conditions and learn how to read charts is the best way to do it by far. I mean, with earnings plays, for example, like we've seen companies beat earnings and dump. We've seen companies not do well in earnings and pump. Like you can't really, even with earnings plays, it's like a risky play. It's a tricky one. You can take lottos if you want. Like for example, Apple performed well on their earnings today and they looked great after hours. If some shit happens overnight with Russia, no matter how good Apple does today, tomorrow morning, all Apple calls are going to be worth nothing. If the market just craters, like I'm not saying this is happening, but like hypothetically, bad news came out, like it'll have that negative influence on the market and it'll include all of the underlying securities as well. So with your earnings plays, it doesn't hurt to take a lotto, You
stink.
It doesn't hurt to take a lotto on earnings plays, but in terms of taking like industry knowledge, like that is great for shares. Like there was this one stock, MP Materials. It basically what they do is they have ownership of a mine like above California for semiconductor metals. Had you bought in calls a year in advance at this level, you bought a $20 call for 2022, reached $53. I don't even know what the return on that would have been, but it would have been significant. Very, very significant. So this is a good example. Thank you, Cody. I appreciate it, man. Yeah, this would have been this is a great example of when an industry play works. Like even AMD is a good example, honestly. If you go to an AMD week chart, if you knew AMD was going to be a top semiconductor performer in 2020, and you bought a $50 call when it was at $30 here, or this 2019 for 2022, and you exit at 164. So industry knowledge definitely works with leaps, but has nothing to do with the short term. Short term is 100% technical. Hey, dude, that's good. If you got stock on AMD before the pandemic, hell yeah, that's what's up. Send me one. Send me a share. I'm just messing. Do I use 2-3 minute first swings and day trades? So whenever I'm trading at open, sadly, you have to, like, for me, bad habit of mine, I can't do anything with it. I can't get myself to stop, but I trade the 1 minute for the first 30 minutes of market. It's like insane just because you get so many fake out candles. But then after the first 30 minutes, I move to 2 and 3 and then 5, like later on in the day. So like if I'm trading between 11 and 2 o'clock, I'll be on the 5 minute. But then when I get closer to power hour, I'm moving back down to a shorter time frame, like 2 or 3 minutes, just so I can see every move, like with the index. Now for swing, that was for day trading. That was for day. I didn't even see you mention swing. For swing trading, I like the 1 hour. I think the 1 hour is the best time frame for swing trading. I think that, the 1 hour is just such a good, like, MSFT. Let's go to MSFT. I think the 1 hour is a good divide between like a short swing and a long leap. But we explained this in the last lesson. I'll go ahead and do this now, honestly. So let's say you're approaching like a new stock or a new ticker you have never approached before. The first thing you want to do is you want to start on like the month chart. There's nothing you can do here, really. It's just like a straight line up. You go down to the week chart. Let's see what we can analyze on this week chart. So we definitely know this is a strong support. This is from when COVID pandemic was first announced. So you can see that, oh, this is alpha resistance. No, it wasn't. So you can identify a support level there. Failed to break above there. I'm just plugging in important price levels, basically. So we have these 4 important price levels. All I'm looking for is like a rejection, a bounce, double top. Like for example, it rejected this high right here, retested, broke, new high. Then I go down to the day chart. Then I do it again. Right here. We can take this. Where did this go? Yeah, so like right here, it's right here. This is a little bit of a weaker support, but definitely want to just keep considering. Work your way down, go to the 4 hour, do it again, find out where your next level is. Here, you can assess a trend line, probably right there. So yeah, looks like if Microsoft breaks 306, damn, I'm gonna put this in the Discord, say less. Looks like we might play Microsoft calls tomorrow, actually. That's funny. How do I get this copied? All right, we'll get this in the Discord. Premium charts. Boom. Easy Microsoft chart. That's literally what I do for all my charts. I just start on the week or month, go down a week, go down to 4 hour, go down to 1 hour. Are you bullish or bearish for the morning? I mean, it's after 8 p.m. We can look at futures really fast. I'll check them out right now and see. Am I bullish or bearish? I honestly have no predictions for this week. Futures are very green though. If y'all can see that. Very, very green. Let's hope it holds through the nighttime, but at the end of the day, like there's no telling what's going to happen. I could tell you I'm bullish. It wouldn't, like, we'll just have to find out in the morning. I've realized that's the best approach to take. Like when the market gets choppy, like I showed you guys this SPY 1 hour chart. When you see stuff like this, there's a 50-50 chance that if I say I'm bullish, I'm right. If I say I'm bearish, I'm right. But I've just realized, like, take it with what you got. Like, for example, oh, dude, this is a prime example. If you look right here, SPY legs up hard at the end of the day and then just resets. Like it practically opened similar to where it opened the day prior. So all of this movement right here went to nothing, reset, did the same thing, reset, did the same thing, reset, did the same thing, reset. So when you see chop like this, like just take the market as it comes to you and just use the pre-market level. Like I assure you, it will never, never, never fail. Someone asked what indicators do I use? So I'm a very big pattern trader. Is like my favorite way of trading is just assessing patterns. If I can find like let's see what pattern we can point out here. SPY is such a bad option for this. Actually, I'll just show you all this just for the sake of time. Why won't this let me come over here? All right, whatever. It's not letting me show you on my Discord. Let me switch the screen I'm sharing to. So right here we have the MTC Discord. Like here's a prime example. My favorite way to trade is definitely to assess patterns. And then I use indicators to gauge what's going to go on behind these patterns. An indicator will help me tell like, oh, is it going to break this resistance? Is it not? Bitcoin downtrend right here. Like just assessing patterns is my go-to for how I trade. Now, in terms of the indicators I use, I just like to find indicator pairs that look well with it. So one that I recently started using thanks to Vision is this open breakout. So that out of there. Take this one out for now. All right. So what this one basically has is this indicator called cumulative monster delta. And it works especially well on short time frames. I can show you right here. Just need to pull up to find where it's at. So it's like a display of like the, I guess, strength of the stock. I like to pair this with a stock RSI and then what we call Welkin's VSA overlay. What this basically shows you is volume zones. It's very good on short time frames because you can play like breakouts such as these. Like let's say you notice like this hit a reversal. you can play the reversal on this. Like we noticed that this lined up well with this support zone. This is a medium volume zone, this yellow one right here. You get a bounce right here, return to the upside. I can give you guys all these like indicator names if y'all are interested. I can't see the chat anymore. But is there like a specific indicator you want me to talk about? Or do you want to just like know all of my like indicators I use? Oh, you want to learn how to use Bollinger Bands? Okay, yeah, we can go over Bollinger Bands. It's a good setup. I just need to add it. I don't use it myself, but I know I've used them before. All right, so right here we have a Bollinger Band double RSI strategy. Can I share some insight on risk management? Yeah, of course. Let me answer his question about Bollinger Bands and RSI, and then we can tackle risk management. So RSI is a very easy indicator to use. It's a great one. I love it. Basically with RSI, you have these two levels, 30 and 70. So whenever a stock's RSI pushes 30, we reference this as oversold, meaning that it's going to reverse to the upside. So with RSI, all you're really looking for is just like playing these oversold or overbought bounces. So if it goes up to 70, it's overbought. I can show you this on the chart on a short time frame because that's when RSI is best in my opinion. So like right here, this is like such a shitty market day to be using for an example. Okay, here's good. Here's a good one. So you see how RSI right here is pushing 70 overbought, you know, as it dips below 70, you get this sell off, you know, you can buy puts here. Does it again, as you see RSI dip again, you can take this sell off right there. So really all you're looking for with RSI is that if it's over 70, expect it to reverse to the downside. If it's below 30, expect it to reverse to the upside. It's like right here, it got very oversold, bounced a little bit. Same thing right here. When oversold, bounced. So you can see that right there. You follow me on there? 912. Like how to use RSI. I'll take that as a yes. But yeah, just in case you didn't, if it's over 70, expect it to reverse to the downside. If it's below 30, expect it to reverse to the upside. Now with Bollinger Bands, I forget the actual calculation that Bollinger Bands are achieving. If I'm not mistaken, this center line is this is their the linear regression line. And then this is, you have an upper band and a lower band. So the lower band will always act as a support. The upper band will always act as a resistance. It's not really common that theoretically with Bollinger Bands, when you're trading with them, you shouldn't expect it to break out too much, you know, on higher timetables, yes. But if you're trading it on a short timetable, like for example, on the 1 hour and 4 hour, you'll definitely see it break out of your Bollinger Bands. But like on a 3-minute chart, it's not very common for it to do this. But this chart is just displaying that. So all you're really looking for is just for it to follow through these like waves, kind of like you're just going to see it teeter back and forth and back and forth. It's especially noticeable on day charts. This is just like a really bad Bollinger Band like indicator. Find a regular one. All right, I like that one a lot more. Right, so like with this Bollinger Band, you have this linear regression line going through the middle, and you're just sort of like trading it, bouncing back and forth. Like it bounces off like right here. I like Bollinger Bands for high timetables more than anything. So you see it bounce right here. It's just bouncing off this linear regression line. And that's like the easiest way to trade it, in my opinion, is just the linear regression line break, because there's really no telling how long it'll sit in an upper band. It's very common that if it does break out of the Bollinger Band, it'll reverse back in. But it can, like, for example, right here, it can like reverse back in and continue. Here it can reverse back in and downtrend. But with this linear regression line itself, though, you can see right here, this break gave you like a steady sell-off, like broke at $81, bottomed at 72, $9 move, you know, on the contracts. That's nice. Right here, fakes out, recovers, strong push upwards. So Bollinger Bands is great for higher timetables. I was planning to code an option watch list maker for swing/J trades using Python. So Um, if you were to code an option watch list maker, I think it wouldn't, I don't think you should base it off of the option contract. I think you should base it off of like a ticker. I think you should base it off of like a screener almost would be my 2 cents, is that you want to just look for stocks that are bouncing off of support, rejecting a resistance or whatever it may be. Because like, for example, like if you go into, I'll show you all right now, go on to finviz.com and you click screener. Let's just click wedge down breakout. I'm looking for volume over 1 million, optionable stocks over $20. And then the only pattern I want to see is just that it has a wedge down. So when I go to charts, if you can find a way to code this, I think that would be great. But the thing is, like with an options watch list maker, I just like, there's just so much fluctuation in the price of these options and they're Greeks that like, I don't even know how you would like even be able to code that. Like, I don't know what you would code for specifically. You could possibly code for like increasing delta, maybe. I would assume lowering theta, but if you were really to code, I would say definitely look at trying to emulate something like this, like emulate a screener, coding your own screener. You know, with that, you can do unusual volume. You could do so many different things. Now, for the person who asked, can you share some insight on risk management? Yeah, I can pull this back up. Again, it's not letting me share on this screen for God knows why, but basically, I'm going to switch my screen again just so you can see the risk management page again. Right here, we have risk management. No matter what, never enter more than 20% of your portfolio into a single trade. You know, you just don't want to over leverage. If that play goes bad and you lose 50%, you just lost 10% of your portfolio at once, you know? Whereas if you're only going into a position with 10% and you exit at minus 20%, you only lost 2% of your portfolio. So never go over 20% into a trade. If you're trading weekly expiration contracts, so like, let's say you're trading a contract that expires on like tomorrow, don't let that contract be more than 10 to 15% of your portfolio. And if you're going to take that position to begin with, make sure it's very high conviction, because at the end of the day, you can always buy the next week out, you know, and it'll just save you a ton of delta and theta risk. For shares, as we said earlier, like if you're building a portfolio of like strong stock, like your Apple, your Tesla, your Facebook, your Microsoft, your Berkshire Hathaway, your ETFs, indexes, whatever it may be, like I guess you could say low risk positions, then it's okay to exceed that. Like if you have an RA of like straight up Apple stock from 2012, like you're chilling. If you were to buy a bunch of Tesla stock, throw it in an IRA, wait 20 years, you'll be fine. With risk management, most importantly, like I guess we would say, make sure there's a reason you're entering your trade. You know, actually, I'm glad you bring this up. I'm glad you bring this up. Say no more. I can drag this over to this side just so I don't got to keep switching. I'm about to pull up a chart again, just so it's like right here. All right, let's go to like a 5-minute chart. Get this ugly ass shit off my screen. So let's say you were to just, assuming you wanted to buy a position into AMD early in the day, even right here, like on this red candle, there would have been no given factor as to why you would enter either position, because it's not near any support. It's not near any resistance. It would have just been guessing that AMD is going to continue falling, you know? So the most important thing with risk management is like reduce your risk before you even buy the position. If you're entering off of like a rejection of this, for example, you notice AMD doesn't break above this level, because here you can take 2 trades. If it breaks this level, this white line right here, you could have taken calls to the upside, possibly all the way up to 115.46, you know, but if it rejects, you can take puts. So I guess a very important lesson with risk management is just like, make sure the trade is there to begin with before you take it. Even on the 3-minute, like if it breaks, calls, doesn't, puts, don't over leverage. Risk management is something that's very simple. I think like something to keep in mind with risk management is control your greed. At the end of the day, you're not going to become a millionaire overnight. You're not going to become a billionaire overnight. It just doesn't happen that way. So control your greed, and that's the easiest way to preserve your risk, because you'll see it time and time again that where like someone will see like one green candle and then they'll go flood a position just thinking like, oh yeah, like this is going to be the one for me. So consistent profits, don't over leverage, do not force trades. Make sure that when you're getting into a position, you have a position to exit at. Like if I was to buy puts here, for example, let's say I expected it to reverse and it continued higher. This is probably the level that I would have chosen. What's it called? Like to cut my puts at. So if I bought puts right here and it rose higher to right here, I would have cut my puts right here. This would have been my stop loss. You know, if I bought calls to break this, my stop loss for that would have probably been like right here, you know? So that way I have a place to exit off of. I mean, shoot, the second you notice that it didn't break the resistance, you could cut your position. So really with risk management, all it falls down to is making sure the trade is there to begin with. You're not putting too much money in, and that you are managing it well. Do not be greedy. Do you do a stop loss based on, oh, I do all of my stop losses based off of support and resistance levels only. Like there's nothing else that I consider with stop loss other than a support and resistance level, simply because like you can take, for example, like why that's the best way. Like, okay, let's say you were to say like you wanted a 20% stop loss. So let's say I bought calls right here and I want to go right up to here, like to this level right here. Let's say this support is 25% away and I cut calls at 20% and it somehow bounced and recovered off this support. I would have cut my calls for nothing, you know? So I always base it off of a support and resistance level. Now, sometimes like you can also say like the other side of that, correct, this is happening to me. Yeah. Okay, so then in that case, definitely just use support and resistance levels. Like these are just pre-market levels. Like anyone could have seen this rejection coming. It would have either broken, it would have rejected. All you had to do is just put like this one singular line is the entire trade here. So use pre-market levels. It's the easiest way to do it. And then if not, if you don't want to use those, just make sure you're starting at the day chart and you're just, you know, as we did earlier, just working your way down. Like, for example, we can assess the support, like, where would this be? Probably closer to there. Right here. AMD has support at 99.79. When you come here, you could set your stop loss to like this level right here. If you were to take calls on the bounce, this is literally how you could set this up, is just that you have this support right here. If it breaks this support, you have another support right here. If it breaks that support, cut your position. If you have the right contract. So like, for example, if you were to trade this, right, and it breaks this support and then it approaches this support and you're trading a contract that expires in 2 days, your contract might be down like 30-40%. If you're trading a contract that only expires 1 week further, your contract might only be down 10%. You know, the further the expiration, the less theta decay, the more strength your contract has, the more value it will retain. Yeah, this video will be made for review. We're having it recorded via Zoom and screen recorder. So it'll do its thing. Do we have any more questions? How to confirm the price has broken a resistance or support? You just want it to close above. So if you go to like a 2-minute chart, let's see. Oh, this is a prime example. So you see, this is what we call a pre-market pivot. It's like a level that it like just bounced off and changed direction. The lowest and highest level are your pre-market highs and lows. So you see right here how it bounced one more time. You can confirm that this is going to go to the downside because this candle right here, you can probably circle it. No, I'm gonna just put this over it. This candle right there. You see how this candle closed below the support? That's how you confirm that it broke the support to the downside. And then it retested on this candle. The wick didn't close above, as you can see. right there. The wick did not close above. So that's your way of confirming that like it either breaks the support or resistance. I have to go, but thank you for a great session. Very insightful. Anytime, man. Anytime. Yeah, literally just one candle above or below for Pahlavi. Just one candle above. You know, that's how you confirm it. Just watch out for fake outs. Like for example, this one closed below and then the next candle immediately recovered. That's what we call a fake out. So just keep watch for those. But the bottom line here is just that one candle, if it closes above, it's broken the resistance. If it closes below, it's broken below the support. I'm using Robinhood for a long way out of the money, a call 2 years out, 3 years at a time. But the contract has been in the money on multiple occasions. But every time I adjust and try to sell it, it fluctuates to being out of the money again. But then if I cancel, it goes back up again. I'm using. Oh, are you, so Robinhood has very slow order fills. I think what's going on is that when you're selling it, you're placing a limit order, I assume, and then it's just not filling in time.
Only person owns a contract.
Oh, what's that?
It's like contract orders, buys versus sells.
Yeah, wait. Oh, yeah, actually that also could be it. Are you when you're selling the contract, are you clicking on the contract itself or are you trying to sell it through the option chain? LW, you're more than welcome to just like get on the microphone if you want.
Right. So it's basically I had bought them, but it's been in the money like let's see, one time. So what is the, I'll just look it up. 1 second. So it's for
Yeah, what's the ticker?
January ENB. So and the call is January 19th, 2024. $60 call. ENB.
ENB. Let me take a look. You got a $50 call for ENB for 2024.
Yes, a $60 call. So it's the furthest one out of the money.
And you're saying whenever you try to sell it, the value changes?
Yeah, but it's been in the money on multiple occasions. Because it's, I suppose it's because the expiration date is so far away.
Yeah, so I see what you're saying now. I see your question now. I thought you meant like when you were trying to sell it, like in that one given like 2-minute time frame when you're trying to sell it, it just kept fluctuating back and forth. Yeah,
that has happened before too, as well. So like if I had, let's say it was at 35 cents from not being in the money. So or it was 35 cents per contract, or $35 per 100 shares, after becoming in the money. But then if I hadn't set a sell order for a certain price, or say I set the sell order for like if it hits $50, right, per being in the money, then or when I try to sell it at adjust to sell at 35, it drops immediately below 35. Does that make sense?
Yeah, that makes sense. So what you're confusing is what in the money is. So when a stock is in the money is like, you can see my chart right now, right?
Yeah.
So you see how ENB is at 41.19?
Right.
Any strike price below $41 is in the money. It has not the value of the contract, but the strike price. So if you were to have a 40 call, that's in the money. 35 call in the money. If you have a 45 call, it's out of the money. So what was happening with you is just that the value of the contract.
Oh, I see. Because my contract is still out of the money
yeah, it's still out of the money. Right? But the thing is, you can still profit on an out the money contract. Like for example, let's say you bought that same call right here at $36 for $10 and it got up to 40. At $40, it'd probably be worth $30. It's still out the money, you know, but it's attained more value, especially with lead plays. Because keep in mind, like with these lead plays, your theta is essentially non-existent. So you're only focused on delta. So like, that's why, like we say, like if you were to buy A and B calls, like, you know, way back, like at $30 or even better. I don't know why I didn't use this example earlier. If you bought Tesla calls when this shit was like This is like $70. Like, dude, if you bought Tesla calls at $70 and for 2021 and you sold it at 1,200, like you probably would have. I don't even know, man. Like that would have easily been like at least $100,000 in change of price at minimum. Because keep in mind, like it went 70 calls, 71 calls, 72 calls, 73 calls. Then when Tesla got expensive, it went 305 call, 310 call, 315 call, 320 call, 330 call, 340 call, all the way up to like 1,000. Like that's a lot of contracts, a lot of contracts.
I got one question.
What's up, brother?
Hey, so what I was thinking regarding what we're talking about right now, how does supply and demand factor into the buy and sale of the contract? So if I buy a leap for a stock that's not necessarily in demand currently, how does that affect the value of the current contract currently, if that makes sense?
That makes complete sense. And I'm actually very glad you brought that up. And I just realized like I should have mentioned this earlier. So there's another thing that you see when you're looking at the option chain, and it's called open interest. Now, what open interest is the amount of available contracts. So like, let's say someone has to write the contract. Like, let's say I have $100 or 100 shares of Apple. I can write a selling contract, for example, so someone has to write the contract. So we have this thing that we call open interest. So you can click on literally anything. And then can you see that right there? I can zoom in on it. You see open interest?
I got you. Yep.
So there's 6,489 active 172.5 calls for Apple. So it's very likely that if you were to try and sell this, there's someone to buy it,
That means contracts, right?
Yeah, contracts for that strike price, right?
Okay.
So let's say I go to a stock like QS, right? And then I go look at their option chain. Where's that one I just clicked on? This one only has 18 open interests. So there's only 18 available contracts. So the reason I bring this up is because you can assume that if the open interest is very low, that people aren't going to pick up that contract. Like you don't, you know what I'm saying? But if the open interest is like 10,000 contracts available, you can assume that a lot of people are interested in this ticker and they're interested in this contract. So it'll be exchanged freely. So something like, let's say like I have a QS call for $50 for 2024 and I want to sell it. Someone's got to buy it. If no one buys it, it won't fill. Even if you sell your limit lower than what the limit, like for example, I was to sell this, like, let's say there was 0 OI on this, just for example purposes, and it was worth $10, right? I could try and sell it for $5, but it's likely no one's going to want to buy it,
Price. Yep.
Yeah. So that's one thing. I'm very glad you brought that up. Yeah. So like, but at the end of the day, like with most of your lead plays, like someone will buy it, especially if it makes the move you're looking for, someone will buy it. Like if you buy a lead play on Apple, you don't have to worry about it. Facebook, you don't have to worry about it. Only be worried about like super, super small stock. But I assume you're buying that lead play because you expect it to have a lot of future growth. Future growth equals more attention. Contracts are written every single day. So definitely just make sure that like if you're going to buy a lead play, just look for open interest above like 500 to 1,000 as like a floor for that. Is my 2 cents there.
Thank you, bro.
Bro, anytime, my man. Anytime. You ready for tomorrow? You ready to make some profit tomorrow? I'm hyped.
Bro, I'm beyond hyped.
It's gonna be a good one, man. It's gonna be a fun one. I don't know what we're getting ourselves into, but whatever it is, it'll be a good one.
Well, I'm underground right now and I can't go nowhere but up. Let's go, baby.
Damn right. Damn right. That's funny. We'll get it good tomorrow. We'll get it good tomorrow. I like the way this
start at the bottom every day. Work your way to the top.
Got to, man. Got to. Best way to learn. Just got to go ahead and do it. Does anyone else have any other questions? Just because this call is wrapping up in like 10 minutes.
I got a quick question.
Yeah, what's up, man?
So I know you guys play mostly like on the spy calls and puts and stuff. if I have an option that I feel like I want to trade, would I be able to like send it to you guys and you guys look at it and see if it's a good call or put?
Oh yeah, bro. Definitely. You can just ask it in main chat. Are you a part of MTC Premium?
Yes.
Okay, then yeah. So you can just, if you just message in main chat, just be like, hey, use at, like the at symbol, admin, and just be like, hey, I'm looking at this position. Would you be interested in letting me know what you think? Someone will answer. Y'all can see the chart screen. So I'll show you like another place you can go to. You can go to ask questions, like this is all you got to do. Just be like at admin. Don't do that one. Do the red one. Make sure you do the red one because the other one's a bot. You could just be like, hey, I have a question. Should I buy 150 call Apple? And then it notifies us. So you see how it turned yellow? Since I have the admin role, it sends me a notification. It says like so-and-so asked a question and ask questions. And then we'll go back and we'll just answer. Like this entire channel is like designed for that. Like, for example, this person asked, I was trying to buy February 18th, $80 calls on XOM, and then Khaled responded, helped him realize that he didn't have all of his strikes showed. So you can do this with anything. You can do it in main chat even. This is definitely where you'll get the fastest responses in here. And yeah, always feel free, man. Always feel free to ask.
Great, thanks. I appreciate that.
Hey, of course, brother. Anyone else? Oh, IDW, can you find us a good one for under $5 contract? So just because I don't know what direction the market's going to go tomorrow, I can't necessarily tell you what exactly you should buy, but what I can show you is how to find stocks that are good. If you go to FinViz, right? And you don't need the paid account for this. We have the paid account just because we want like access to all the parameters, but you can do this off the free account. What do you want? You want to click on descriptive and then go to optionable. And by the way, this is recorded, so you can go back and watch me do this later. You want to click optionable, and then y'all can see FinViz, right? Like this white screen right here.
Yes.
Okay, bet. Click optionable, and then you can just click custom. Let's say you want to do $10 to $30 stock. And then you can do relative volume. You always, or not relative volume, where is it? Current volume. You want current volume always to be over 1 million. And then you can go to technical. And over here, you can pick different things. What I like the most is the pattern function. My favorite triangle or my favorite pattern to screen for is triangle descending strong, because when something breaks out of a descending triangle, it breaks upwards. So it'll just show you like different stocks. Now you can do this with any pattern. You want to do a wedge up, you'll find stocks, and this will help you find, like, for example, like let's just take APG, just because it's the first one. This is a $21 stock. It's very likely the contracts on here are very cheap. So like, let's see. Yeah. So like this is $1 out the money is 70. This is like weird. I don't know why. This is a bad one. Let me click on another one. I don't know why their option chain looks like that. Disca. This is a great one, for example. Screw this damn stock. Fucking hate it, but it's a good example. So yeah, like the $30 call on a $26 stock is only 40 bucks, 1,500 or 15,000 open interest. Good delta, significantly larger than the theta. Like this is a perfect, like this is what I would call an A+ contract, is because it has a high open interest, meaning that there are a lot of available contracts. And then it also has, I don't know why it's not letting me highlight anymore. It has delta that's like 9 times page unresponsive. Just wait. It has like 9 times the delta to theta ratio, and it's only a $70 contract. So this is a great way, is just using FinViz is like, it'll give you the chart for you. Like I didn't analyze this at all. Like this just did it for me. It's free. Like BKR. I see this one all the time. Just go back to this once it loads. In case this, I don't know why this is like glitching. But yeah, just use FinViz. Set your filters back to like I'll show you all the filters I had again. I just clicked wedge up, and then under descriptive, these are the three things you want to always have. Volume over 1 million. You don't want to get a chart that just going like, you know, you want to see some of that up and down. That's where you get the options from. And then optionable, you don't want to look at a ticker that you can only buy shares for. And then you can literally put like a price range. And then the cheaper the stock, the cheaper the contracts will be. And it'll be perfect for like smaller portfolios. Did that answer your question well?
Absolutely. Thank you so much.
Of course, anytime. Does anyone else have any other questions?
That was everything right there. So I'm glad I asked that question.
Okay, perfect. Yeah, FinViz 10 out of 10. Like, I love using it. It's great. There's so many different things. Like you can even do things about earnings. Like you can literally screen for today after market close earnings. Or well, obviously today's done. So we can do like tomorrow after market close. Let me take off this. Technicals. Let me take off all the technicals. I don't know. There we go. So these are all the companies that have earnings tomorrow. Right here, gives you the chart and everything you need. You know, so you can even do tomorrow after market close. Probably tell us something.
Puts on CHD.
What's that?
The puts on CHD.
Oh hell yeah! That. Let's see. What even Church and Dwight? Know what this shit is? $25 billion company though. Wow. So yeah, they have earnings tomorrow. Maybe we should literally watch it here. I'll send that message in Discord.
Don't quote me, bro.
Nah, I know. I'm just gonna put like I'm just dropping that in there. I mean, who knows? Like it's ran up it's ran up a lot. Like it's up a decent amount recently. So it's already starting that red. So who knows? Maybe puts on CHD will be our play for tomorrow. Yeah, I just dropped that in there just so I can look at their earnings tomorrow. Do you look at outflow and inflow when you trade? Sometimes it's more inflow and it's going down. Yeah, so I do look at outflow and inflow when I trade. Yeah, sometimes you'll see more inflow and it's going down. That's rare. But the only time I'm really concerned with outflow or inflow is when you see something that's like 70% outflow for 30% inflow. So just if it's like 50-50, it's just probably going to consolidate. Like only be concerned with outflow and inflow when it's like it's a big gap between the two. It's like when it's most important. But this call is going to like automatically shut off in 1 minute. I just wanted to say thank you guys so much for sticking till the end and hanging around with me. It actually means a lot.